Here are 5 companies that could quietly make you rich with Trump's 100% tariff on Chinese goods. And Wall Street's already reacting, so you better don't get left out. The first up on the list is one of the clearest winners whenever the US doubles down on domestic manufacturing and infrastructure: Caterpillar. If you've ever seen a construction site anywhere in America, you've seen that yellow logo. Bulldozers, excavators, loaders. Caterpillar is the backbone of physical development. But what's often overlooked is just how deeply tied the company is to the cycles of trade policy and government spending. When imports from China get slapped with 100% tariffs, the cost of foreign heavy machinery skyrockets. That instantly levels the playing field for US producers. And Caterpillar doesn't just compete here, it dominates here. They hold over 40% of the US market share in construction equipment. But there's another layer to this story. Whenever tariffs rise, governments tend to roll out stimulus spending to offset the economic drag, usually through infrastructure projects. New highways, bridges, manufacturing plants, and energy facilities all need one thing: heavy machinery. And Caterpillar is the first company in line to sell it. But the market often misreads Caterpillar during crises. When fear hits, investors assume all industries will collapse. But history says the opposite. During the early months of the 2018 trade war, Caterpillar's stock dipped with the market, then surged over 30% within a year as spending shifted to domestic projects. That same dynamic could easily repeat now. So while traders panic about tariffs, long-term investors should recognize the pattern. Infrastructure, manufacturing, and domestic construction always follow protectionism. And when those sectors expand, Caterpillar roars. Next up on our list is an American icon, Deere & Company. But John Deere isn't just about tractors. It's about the backbone of American agriculture, and agriculture is about to play a central role in the next phase of this trade war. Whenever the US and China clash on tariffs, the agricultural sector becomes one of the first battlefields. China retaliates by taxing soybeans, corn, and wheat, while America counters by protecting domestic farmers through subsidies and stimulus. That means more spending on equipment, more demand for efficiency, and more orders for Deere. Every trade war in the past 20 years has ended with the same result. When global exports fall, American farmers double down on local production, and Deere sells more machines. Deere's edge isn't just its reputation. Over the last 5 years, Deere has quietly evolved from a farm equipment maker into an agricultural technology leader. Their tractors and harvesters now run on advanced GPS, AI-driven precision farming systems, and autonomous navigation. They allow farmers to plant, spray, and harvest with almost surgical accuracy, reducing waste, cutting fuel costs, and boosting yields. And in a world where tariffs make imports expensive, every saved dollar on efficiency matters. The company also has deep government ties. When Washington decides to support farmers during economic stress, Deere often benefits indirectly. Loan programs, tax incentives, and grants for agricultural modernization all lead to one thing: more sales of US-made farming equipment. Now look at the numbers. Deere's revenue has grown steadily through multiple economic cycles, and their 2025 earnings outlook already reflects rising equipment demand in North America. And with these new tariffs on foreign machinery, that demand could accelerate sharply. Next, we move from the fields to the factories: Tesla. The third company on our list is the most controversial, but also the most adaptable. Here's why. A 100% tariff on Chinese electric vehicles doesn't just hurt imports. It gives Tesla a near-instant advantage on home turf. Chinese automakers have been quietly expanding into global markets, offering cheaper electric vehicles that undercut Tesla's price points. Those vehicles now become twice as expensive to bring into the US, effectively removing Tesla's most aggressive competition overnight. Tesla manufactures largely inside the United States, sources many of its critical components locally, and has already built its own supply chain for batteries, parts, and assembly. While other automakers scramble to renegotiate contracts or pay higher import fees, Tesla's vertically integrated model means it keeps control and its margins. But it's not just about cars. Tariffs trigger government incentives, and the clean energy space is often first in line for stimulus. And that directly feeds into Tesla's ecosystem. Financially, the fundamentals show resilience, steady free cash flow, record vehicle deliveries, and an expanding energy storage business. The company's diversification, from vehicles to solar to grid batteries, positions it as more than an automaker. It's an energy and infrastructure play which becomes even more critical when import costs rise and domestic alternatives are needed. Investor psychology also plays a role. In every economic shakeup, people look for a face of optimism, a company that represents innovation instead of decline. For this era, that face is still Elon Musk. Love him or hate him, Musk's presence ensures Tesla stays in the conversation, in headlines, and in investors' minds every single time economic uncertainty hits. Next, we turn from the futuristic to the foundational. Nucor Corporation is the quiet giant of U.S. steel. You won't see its logo on flashy advertisements, but you'll see its steel everywhere, in bridges, skyscrapers, pipelines, cars, and even the rebar under your feet. In every major tariff cycle, steel becomes the centerpiece of the story. When imports get hit with 100% tariffs, foreign steel becomes uncompetitive almost overnight. China, a traditionally major steel exporter to the U.S., finds their products priced out of the market. That leaves American producers like Nucor to pick up the slack and often raise prices in the process. And Nucor isn't just any steelmaker. It's the most efficient one in the country. Unlike old-school steel giants that rely on blast furnaces and imported ore, Nucor pioneered the use of electric arc furnaces, which recycle scrap steel into new products. That method is cheaper, cleaner, and more flexible. It means Nucor can ramp production up or down based on demand, without the long lead times that cripple its competitors. When the last major steel tariffs hit in 2018, Nucor's stock jumped more than 25% within months. Profits surged. The company opened new facilities, expanded its workforce, and used the momentum to invest in next-generation mills across the South. Fast forward to today, with another tariff wave on the horizon, and Nucor is better positioned than ever. Beyond simple supply and demand, there's a political tailwind here too. Steel is one of the few industries both parties agree should stay American. For investors, Nucor represents the simplest thesis in this entire trade war. America needs steel. Imported steel just got twice as expensive. Domestic steelmakers now control the pricing power, and Nucor sits at the top of that food chain. Our final player is the defense titan Lockheed Martin. When trade wars escalate, global alliances strain, and national security becomes the top priority, defense contractors like Lockheed don't just stay stable, they thrive. Lockheed is America's largest defense manufacturer and the backbone of the U.S. military's modernization program. From fighter jets to missile systems and satellites, its technology defines America's defense capability. In times of geopolitical tension, defense spending doesn't shrink, it expands. And tariffs, especially ones that fuel rivalry between the U.S. and China, almost guarantee that defense budgets will keep climbing. Unlike consumer sectors, defense contracts are insulated from inflation and short-term volatility. They're multi-year, government-backed, and often renewed automatically. That means while the rest of the market reacts to panic, Lockheed enjoys stable, predictable cash flows. The company's fundamentals reinforce that security. Strong balance sheet, consistent dividend growth, and a backlog exceeding $150 billion in confirmed contracts. That backlog is like a guaranteed paycheck stretching years into the future. And when new geopolitical shocks hit, that backlog usually expands, fast. Hey, if you've enjoyed this video, hit that like button and subscribe for more content like this.